problem from your last note sheet. So if you guys can go back into Google Drive and get your current liabilities notes, which look like this. At the end of your notes, there is a problem. It is 11.1a. It's going to be a practice problem. It's going to go through a lot of the stuff that we have talked about already and some stuff that's going to kind of refresh your memory. The transactions are in Classroom, so I'm going to be flipping between these two here, and I'm going to use this as a guide to kind of go through with you how these payables look. Now, what I'd like you to do at home is I'd like you to try to attempt to go through some of these transactions on your own. If you get stuck, play the video, go through it, understand it, and so on, but some of this stuff you should be able to do on your own. So we're going to start here. We are the Emerald Bay stores. So we are buying stuff to put on our shelves. We are taking out some loans and paying off some stuff. So here are all of the transactions. I'm going to start with January 15th. So I'm going to go to my journal and put in January 15th. Looks like I'm buying stuff to put on my shelves. So I'm buying merchandise to put on my shelves and it's on account. Since it doesn't say note, I know that this is an accounts payable. So I'm going to owe money within 30 days. And sure enough, the terms are N30. They aren't offering a discount and I'm owing money to the Hood Company. So when I buy stuff to put on my shelves, the asset account that is increasing is merch inventory. And the amount was $220,000. Nope. And my credit, since I owe money, is accounts payable. Now, in addition to just journalizing this, I am also going to be pretty specific who I owe money to, because in this problem, I'm going to have multiple people who I owe money to. So this is to the Hood Company. Now, in addition to that, I'm going to try to keep track on the side of these T-charts and who I owe money to. So the first one is going to be to Hood, which I'm going to try to draw out. And I owe them $220,000. So I'm just going to keep track of T-charts as I continue. My second transaction, so I'm going to highlight this one off. Done with this one. I took out a loan or a note from the Hood Company. You can see that this is 30 days later. So my bill is due. So instead of me paying a bill, I don't have the cash to pay the bill. I am going to turn my accounts payable into a note at 12% for 60 days. So I can see now that in order to cancel out this accounts payable, I have to debit my accounts payable to get rid of it. And then I'm going to credit and issue a notes payable to Hoods. This is on February 14th. My debit is accounts payable to Hood, and that is $220. And my credit is going to be a notes payable. And again, I'm going to be specific about it. I'm going to say that this is to Hood. So I'm just transferring an accounts payable into a notes payable. And again, here's my T-chart. And this is going to be a note payable to Hood. And it's $220,000. So this one is gone. I've canceled this one out. And now I just have this notes payable to Hood. So I'm going to continue and go back. Done with this transaction. On April 15th, I paid the amount owed. So before I go back here, let's figure out how much interest we owe on this. So you have to take the face value of the note, which is $220,000. And you're going to multiply it by the 12%. And you are going to then multiply it by how much of a year, which is 60 over 360, which actually equals 0.1667. Now, if you multiply this all out, you are going to get 4,400 or so. And this is your interest expense. So I know that in addition to paying the face value of the note, I have to pay $4,400 in the interest expense. So I'm going to go down here. The date is April 15th. And the first thing I have to do is I have to get rid of this note payable. So in order to get rid of this note payable, I have to debit my notes payable. So to get rid of this note payable to Hood, it's going to be a debit of $220. And I know I'm going to be paying cash. So cash is going to be a credit, but the cash is the combination of the face value of the note payable, $220, plus the interest expense, $4,400. So the amount that I am paying is $224,400. Now my debits don't equal my credits. I see that I have to add $4,400 to my debit side. And since it's a debit, I know it's not a revenue, it's an expense. I'm going to call this an interest expense. And now I am done with the amount that I owed to the Hood Company. And I'm going to go through and I'm going to highlight this one off because I am done with this one. On June 2nd, I went to the bank and I took out a note. It's a 60-day note at 8%. So since it doesn't say it's a discounted note, I know that I'm going to get this much cash when I walk away from the bank. So on June 2nd, I am getting cash from the bank by taking out a note. That's what I get. And that is $187,500. And in exchange, I am guaranteeing them to pay them back with a note payable to Acme Bank. And I'm going to sketch this one out too. So here is my T-chart. I have a note payable. And I owe them $187,500. So that's how much my note is. Now I go back to my transactions and I can highlight this off. All right, on June 10th, it looks like I bought tools by taking out a note. The note is discounted. So the amount of the note is $190,000. I know a discounted note, I pay interest ahead of time. So let's just do the calculations for the interest. Let me make this red. 190,000 times 0.06, which is the interest, times 90 over 360, which you guys know translates into 1/4 of a year. I multiply this all out, and this is going to be 3125. So instead of taking out a loan for the whole 190,000, the amount is 187,000. 150. So I'm not getting cash by taking out this note. I'm getting tools instead. So I'm going to go back here. And the date was July 10th. And the asset that I got was tools, but I didn't get the full 190,000. I got 187,150 because I have to subtract the interest out right away. The note that I owe is for 190,000, but at the end of the note, I won't have to do any calculations. Notes payable. and this is to Columbia. Now the difference between the debits and the credits, I have to add money to the debit side of 31. I got to go back to my notes here. 31.25. Sorry guys, I got my calculations wrong here. It's not 31.25, it is 28.50 for the interest expense. So that's the amount that I have to add on here for interest expense. 28.50. Now, I'm going to sketch out a T-chart over here. I'm going to make it a different color. So here is my notes payable to Columbia. I still owe them $190,000, but I've already calculated the interest, so the asset account that I got was less than that. And I am now done with July 10th. Going on August 1st, it looks like I'm paying Acme Bank the interest due on the note, but instead of paying them for the whole note, I'm only paying them the interest. So I have to take out a new note. So let's do some calculations here. On August 1st, the note is on June 2nd. So I'm going to go up to June 2nd. It looks like I borrowed $187,500. So the only amount that I'm paying is the interest. So let's figure out the interest. On $187,500, I'm going to multiply that times 10% interest times 60 divided by 360, which equates into 0.1667. Multiply all of this out, and the amount of interest that I am paying is $2,500. Now, I'm only going to pay the interest. I'm not paying the note. So let's just take care of paying that interest expense. So on August 1st, I am going to pay an interest expense, which is going to be my debit, of $2,500, and I pay it with cash. Move this. Now, what I actually have to do now is I have to get rid of this notes payable. I'm going to call this notes payable 1, and I'm going to move it into a notes payable 2. So I'm actually converting this note into a second note, and this is going to give me more time to pay. So again, I have $187,500 in the second note. So I'm going to cancel out the first note with a debit, and I'm going to put in the second note with a credit. So again, on August 1st, it is going to be my note payable, and I'm going to put a 1 for Acme of $187,500. And then I'm going to convert this into a second notes payable, because you can't carry the notes payable over. Once the term is done, it is done. So I actually had to convert it into a second $187,500. If I look at my directions here, this is now going to be a 60-day note. So it's going to give me 60 days more to pay. So 60 days goes by, and on September 30th, it looks like I am paying not only the interest due on the second note, but I'm also paying the face value of the note. So let's figure out the interest. $187,500 times the renewal note was 10% times 60 divided by 360. Which equates into 0.1667. And multiply this out, and this is going to end up being $31.25. So I am not only paying the face value of the note, but I'm also paying this extra amount of $30 for interest. So first thing I need to do is I need to get rid of this note, which is going to be a debit to my notes payable. So on September 30th, my debit is going to be my notes payable, and I'm going to put it in for two to Acme, $187,500. And how I pay off a note is always with cash, but it's going to be more than the $187,500 because I have to add in the interest. So the total amount that I am paying for the note is $190,625. The difference between the debits and credits have to go on the debit side of $31.25, and this is, since it's a debit, it's an interest expense. All right, this one is done, so let's highlight this off. On December 1st, I purchased office equipment for $120,000. I paid $20,000 in cash, and I took out some notes. But instead of just taking out one note, I took out 10 notes worth $10,000 each. So every 30 days, another note is going to be due. So let's just journalize the purchase of the equipment. This is going to be a compound transaction since I paid $20,000 and I took out notes for $100,000 and I got office equipment for it. So on December 1st, I got office equipment of $120,000. I paid cash, which is going to be a credit of $20,000. And even though they're a series of notes, I'm just going to call them a note payable. And that is going to be money that I owe to Mountain Equipment. And that's going to be $100,000. Now, instead of having this be just one note, this is a series of 10 notes. So this is my first notes payable to Mountain. And this is going to be $10,000. I could do 10 more of these T-charts because there's going to be a series of 10 of them. So each one is going to be due in another 30 days. So we finished this transaction. Now this December 5th transaction is a little funny here. It's saying we settled a product liability lawsuit. So it looks like something that we sold to a customer, made them sick, hurt them, injured them, they sued us. So we settled the lawsuit for $76,000. We owe them this. We didn't pay them, so we owe them this money. So we are going to call this a litigations claims payable account. So on December 5th, this is going to be a litigation loss expense. That is going to be 76,000. Why do I keep putting this in post ref? $76,000. Since it's a payable, I am going to call it a litigation claims payable of $76,000. So I don't have to worry about paying it until January, so it just sits in that payable. So this one is done. And then I'm going to pay Mountain for the first note. So every time that a different note is due, I'm going to calculate interest on that length of time. Since this is the first one, it's going to be 30 days. So my first note is worth $10,000. I'm going to multiply this times the 6%. And since this first note is due 30 days into the loan, that's 30 divided by 360, which is going to equate into 0.08 And if I multiply this out, the amount that I owe in interest is going to be $50. So I'm going to pay off this first note. So I've got to get rid of my notes payable here. In order to do that, it's going to be a debit. So the date is December 31st. And this is going to be notes payable to Mountain. It's going to be the first of the series of notes, which is 10,000. I'm going to pay more cash than that because I have to account for the interest. And we just figured out the interest is $50. So $10,000 and $50. The difference between the debits and credits is $50. So I'm going to call this one an interest expense. And now I can highlight this one off. That's it. So tomorrow the plan is you guys are going to get an assignment to do. That's going to be very similar to this one. And it's going to have you thinking about all of the payables. Now, again, I'd like us to check in on Zoom, so I'm going to release that assignment at regular time, 7:20 in the morning. If you want to give that assignment a try before we Zoom, that's great. If you guys want to Zoom first, that's fine. And if you guys have questions later, you can always email me. So hopefully if you've got questions, let me know. Otherwise, I will see all of you guys on Thursday.